Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LevFin Insights Levered Lines. I'm Steve Miller, a member of the CreditSights team at Fitch Solutions. Today, we will be discussing a wide range of loan market topics with market veteran Joe Rotondo. Joe is a managing director at MidOcean, where he is a senior portfolio manager of the firm's credit investing team. Before MidOcean, Joe spent 24 years at Invesco. Finally, Joe is a longtime friend of the family here at Fitch Solutions and a great partner in business and on the golf course. Joe, thanks for joining us.
Steve, it's great to be here. Before I get started, just a quick disclaimer. The views that I express on this podcast are my own and not necessarily the views of MidOcean Credit Partners.
Understood. So let's start with a table setter. Let's ask you to talk a little bit about your business at MidOcean and how you aspire to grow it.
Great. Thank you, Steve. So at MidOcean, we manage $5 billion of CLO assets, and the $5 billion of CLO assets were originated over the past 3.5 years. And the business really centers around our investment philosophy, which is very defensive in nature. And this investment philosophy has generated very strong results, and we've outperformed over these past 3 to 4 years. And what that does is it positions us very well to continue to grow in 2026 and beyond. So going forward, we're going to be focusing on two main things. Number one is to adhere to our existing investment philosophy and not deviate. Mm-hmm. And that's especially important in a market like today's market where asset spreads are tight and some managers will stretch for yield in an effort to improve their performance and improve returns. But we are not going down that path because it typically has negative consequences. So that's number one. And then number two, we will continue to expand our investor base. Over the past 3 years, we've significantly expanded our investor base. So accounts that buy CLO debt tranches and also accounts that buy our CLO equity. And that'll be a continued theme over 2026 and beyond. So we're very focused on outreach across the globe to further expand our investors.
Interesting. So let's talk about what's probably the most topical theme of the moment, which is this bullishness around M&A-driven loan collateral volume. So our forward calendar now stands at about $46 billion, which is as big as it's been at any time in the last 3 years. I wonder if you're as bullish as most people seem to be on this theme.
Yeah, it's interesting because over the past 4 years, there's been the LBO activity in our market has been relatively muted, and that's caused a supply-demand imbalance. But our view is consistent with what you just said, which is that we think that 2026 should be a much better year for LBO activity and also M&A activity. And that's important because what it drives is new issue bank loans in the broadly syndicated loan space. And when you think about the environment, there are 3 factors that are working to our advantage. Number one is rates have come down and most likely will continue to come down and tighten in, which is important because it reduces the cost of capital for issuers and borrowers. Number two is that there is a stable macro backdrop, which is also an important factor. And then number 3 is that sponsors are looking to monetize their portfolio companies and return capital back to their LPs. So when you consider these 3 factors converging at once, we're optimistic that we will see a resurgence of LBO and M&A driven new issue loan activity.
Well, that's great to hear. And now take that to the next step of how does that impact what you see around CLO issuance and the CLO market in 2026?
Yeah, so if we look back to 2025, 2025 was a very strong year in terms of CLO issuance in the BSL market. And our view is that we will continue to see strong CLO issuance this year. And especially if we see this resurgence of LBO and M&A activity, that'll be a very positive trend that will help to drive CLO issuance. And today we're starting to see the first deals of 2026. And one encouraging sign is that we're continuing to see a tightening in AAAs. So there are deals in the market right now that are in the very low, where the AAAs are in the very low 120s or in the very high 1-teens. And that's demonstrating a tightening trend, right off the bat in 2026. And that'll be a helpful trend going forward throughout the year.
And picking up on that, and just to put a fine point on it, when you look at average spreads across the stack, do you have a view on how they're printing out now as we start the year?
Yeah, well, in 2025, we saw the entire capital structure tighten in, AAAs all the way down to double Bs, and it appears that that trend will most likely continue given the demand that we're seeing so far this year.
Understood.
Mm-hmm.
So let's talk a little bit about, so that deals with the new issue side of the market. What about refis and resets? That's been a significant theme, obviously, the last couple of years. How do you see that going forward?
Yeah, I think 2026 will be another big year for refis and resets. And when we think about it, starting in the fourth quarter of 2022, we saw liability spreads peak. And then for the next, through end of 22, 23, 24, and 25, we saw liability spreads tighten in. And to put it into context, at the end of 2022, AAAs were SOFR plus 220 and wider, and then today they're down at SOFR plus 120. So what this means is that all of the deals that were done at the end of 2023 and during 2024 are rolling off their 2-year non-call periods this year. Managers now have the opportunity to reset the capital structure and the liabilities at much tighter spreads than those spreads that existed when these deals were originally done. And I think this is very positive for the CLO market. And in particular, it's a big positive for CLO equity, because if we can reduce liability spreads by 50 basis points, for example, then that benefit flows right down to the equity investors.
Makes a lot of sense. So let's switch gears and talk about the credit environment. You obviously came up as a credit analyst, spent many years in that format. How do you view the fundamentals of the market today?
Yeah, so what I think is that we will see a continuation of trends in 2026 that we saw in 2025. And so one trend in particular that we saw was certain loans trading down. And there are two categories when I think about stressed loans in today's market. One is industry specific, and then the other category is more idiosyncratic. So when I think about industry specific issues, for example, chemicals, the chemical industry comes to mind, where demand for commodities has abated, and that's resulting in lower revenues and lower EBITDA, and therefore higher leverage and a strain on liquidity. So we've seen a number of chemical credits trade down in the secondary market. The other category is more idiosyncratic in nature, and these are companies that started off highly levered, and these are companies where the management team has not been able to execute on the business plan. And as a result of that, as a result of the high starting leverage and an inability to successfully execute on the business plan, those companies are in a stressed situation.
Yes.
And we saw in 2025 a number of credits that traded down for those reasons. And I think in 2026 we'll see a continuation of that trend. So what that means for managers is we really need to focus on credit selection. And I think in 2026, credit selection will continue to be paramount.
Interesting. Now talk a bit about the interest rate environment, right? How you guys view it in the sense of short-term rates are clearly coming down. The intermediate and longer-term rates seem like they're fairly stable. How does that play into the health of the credit markets, maybe some fundraising aspects around loans?
Yeah, I mean, lower rates are are very good for the broadly syndicated loan market for those two reasons. Number one is that if SOFR has contracted, and assuming that we continue to see Fed rate cuts, SOFR will continue to move down, and that has a direct and positive and immediate impact on borrowers because their borrowing cost goes down, which has an impact of improving their cash flows, which is positive for credit fundamentals. So that's good. And then also the other benefit is that if rates are lower, that should stimulate LBO activity and more new issue within the loan space.
Interesting. So let me go back to a point that you alluded to in the prior answer you gave, which was around the distressed side of the market. So one of the intriguing, at least to me, trends that we saw in the data in the fourth quarter was this steady and pretty impressive rise in the percent of the markets trading over par. I think we got to like 52% by the end of last year. At the same time, the percent of the market that was trading at 80 or lower went from about 6% in the fourth quarter to 8%. And I wonder how you read the tea leaves around those data.
Yeah, it's interesting because the market, as you pointed out, is become more bifurcated, given the percentages of loans that are trading above par, the percentage of loans that are trading below 80 cents. So what's happening there? Number one is with these loans that are trading above par, managers want safe assets. And given the fact that we haven't seen a lot of new loan supply, managers continue to gravitate to those safer assets. And what that is doing is it's causing a stronger bid. It's resulting in a stronger bid for those particular assets because managers want those names in their portfolios because they're sleep at night names. So that's what's really driving that into the market. And then when it comes to these names that are trading below 80, I think that's resulting from general credit risk coupled with the potential for liability management exercises. And managers do not want to be caught on the wrong side of an LME or a liability management exercise. And then another factor is that a lot of the names that are trading below 80 cents are rated triple Cs, and CLO managers are are closely monitoring exposure to triple Cs because no manager wants to have excess exposure to triple C names. So when a loan is downgraded to triple C, or if the market thinks that a loan will be downgraded to triple C, then the value typically will fall in the secondary market. And what's interesting is that if you can navigate successfully, some of those names that are trading below 80 cents or in the low 80s represent fairly attractive opportunities because there's a little bit of a liquidity premium that's built into the price.
That's so interesting. And so just to follow up on the whole LMT or LME, however we describe it, I mean, as I said before, you've been in the game a long time, right? That is a trend that started, 5-6 years ago. I'm curious to hear how you think that's changed the game as far as portfolio strategies, trading strategies, that sort of thing.
Yeah, it's a good point. And what LMEs have introduced more volatility in the market and lower the likelihood of lower recoveries in the market. So therefore, the credit selection process has become even more important today than it was 5 years ago or 10 years ago. Because if you pick the wrong names, there's much more downside potential, and that could have negative implications for your portfolio. So the view on the fundamentals of credit have become increasingly important. And then also, as part of the process, it's very important to do a deep dive into the credit agreement and to understand what the strengths and weaknesses of a credit agreement are and what levers a borrower can pull to take advantage of those weaknesses in the credit docs. So what is very important is understanding the credit agreement and better understanding the downside risk, given not only the fundamentals, but the fundamentals coupled with the way in which the transaction is structured.
And at a high level, obviously a lot of our subscriber base are covenant focused, right? So at a high level, are there certain covenants that you've experienced in your experience that have been more helpful in staving off LMEs, or is it, the bar will figure it out if it needs to?
Yeah, I mean, what we really do is we look at the entire credit agreement and all of the covenants, and some of the things that we're specifically focused on are the company's ability to move assets into subsidiaries where that subsidiary will no longer be part of our collateral package. That's a big focus for us. And then also the ability for a company to dividend cash out of the company, because that will weaken our position. So we take a very comprehensive view of a credit agreement, and our goal is to understand what the weaknesses are and how those weaknesses could affect our recovery.
Makes a lot of sense. All right, so switching gears, let's talk about a topic we reviewed pretty thoroughly at our lunch here, which is AI, right? Mm-hmm. That's been an incredible wave around all sorts of aspects, including the loan market. I'm wondering how you look at it in turbocharging your own business, and maybe more broadly on how it affects the market in its entirety.
Yeah, well, what's interesting is AI is having an impact on the leveraged loan market. And I think there are two risks, or two categories of risk related to AI. One is perceived risk and one is real risk. And what I mean by the real risk is situations where the probability of AI disintermediation is very high. And a lot of names where that probability is high have traded down in the secondary market, and managers are concerned about what can happen to revenues and cash flows. So we definitely have seen some volatility around some of those AI names where disintermediation is likely. So that's number one. And then another category is perceived risk, where you can make an argument that there could be AI disintermediation. And in those situations, we have seen loans trade down a few points. But then when the market does a deep dive and they figure out, that disintermediation argument really doesn't hold up and it doesn't make a lot of sense, then that loan will trade back up. So those are the two categories that we've seen. But I think one positive when it comes to AI is that as borrowers adopt AI, what they can do is run their operations more efficiently, reduce their cost structure, and as a result, they should be able to generate better cash flows, and that should have positive implications for the overall performance of the company.
It makes a lot of sense. So a couple of final questions for you, a little bit off the loan market topic. So if you think about young people who want to start their careers today in asset management, loans, high yield, whatever, is there advice you give that you think is topical to the times here?
Yes. So I am a mentor for Rutgers Road to Wall Street. So I'm a Rutgers alum undergrad. And so what I do is I mentor some college students. And what I find is that these students are they're very ambitious, they're very eager, and they tend to be very analytical in nature and detail oriented. And one bit of advice that I give them is I'll say, look, it's important to get the details right and to be detail oriented and analytical. But when you're assessing investment risk, it's really important to take a step back and look at the big picture and think to yourself, okay, I'll step back from all the numbers and think about, does this business make sense? Are they appropriately positioned within the industry? Are there any red flags that I see when I analyze a particular credit? So that's some advice that I give to the college students who I mentor.
So it sounds like getting the right skills is critical at this time. Yeah.
Yes. Very important.
And what about yourself? If you think back to over your increasingly long careers, or specific pieces of advice you got that you cling close to in your heart?
Well, I think your portfolio management is similar to golf in certain ways, because for both portfolio management and golf, you have to go through a process of self-reflection and self-evaluation, which may not be pleasant, but it's very important to do that. And one thing that's important is to look at your past behavior and your past decisions and think about, okay, in this environment, this is what I did. And through this period of volatility, these are the decisions I made. And were those the right decisions? What was driving my behavior? What were some of the key inputs to my decision making? So we always want to look back at our past performance and think about, okay, did that work out well? Did it not work out well? And what could I learn from that experience?
Well, fortunately, I think for both of us, we've had more professional success than we've had maybe
Yes,
on the
agreed.
golf course. I have to say one of my least favorite things to do is go to the simulator in the winter and have somebody put my swing on the monitor and then show it to me. That is no fun.
Right.
That's an opportunity for self-flagellation. Okay, well, that's all the time we have for today. Thanks, Joe, for joining us.
Thank you,
Your
Steve.
time and your insights are invaluable. Please tune in next time and catch us when we do this again in a month or so.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.